Adam Bergman here. I got Steve Blackwell, and we are going to be talking about the art of tax-free Roth conversions and how you can unlock tax-free wealth. So just want to introduce myself, and then Steve, you can introduce yourself, and then we can tackle today's topic. I will start and go through the rules of Roth IRAs, Roth conversions, how they work, who's eligible, how they can be done, the advantages, disadvantages. And then Steve's going to go through and talk a lot about oil and gas and talk about how you can combine the tax benefits of tax-free investing through an oil and gas, potentially through high deductions and shelter a lot of potential income from a tax conversion on a Roth IRA. So this is a really, I think, advanced tax planning opportunity. I'm going to hopefully educate a lot of you. This is a really cool tax strategy that people use in different contexts, but I think when you connect Roth IRAs and oil and gas, it's awesome. So who am I? I'm Adam, founder of IRA Financial. I'm a tax attorney, master's in tax law. I've written 8 books on self-directed retirement accounts. I'm a founder of IRA Financial. We have over 23,000 accounts, over $3 billion in assets. And we help people unlock their retirement funds to invest in alternative assets like real estate, oil and gas, cryptos, investment funds, gold, almost anything that you want. So that's my passion. I love educating people about the power of the U.S. retirement system, and super excited to do this webinar with Steve.
Yeah, thanks, Adam. I'm excited as well. I'm excited, probably like a lot of the folks on the call are, to this is a strategy, quite frankly, I plan on implementing myself. So I'm happy to learn and excited to hear your wisdom as well, especially on the Roth side of the business. Personally, I've been running upstream oil and gas companies for over 15 years as an executive. I'm the CEO and co-founder of Invito Energy Partners, which I started a few years ago with my partner, who's been with me for over a decade in this space. And we run an oil and gas investment fund. And we'll get into the how that kind of works and how this could apply into this specific strategy in terms of the significant tax benefits associated with investing into direct drilling funds. So excited to get this started, man.
Let's do it. Okay. So if people have questions, I guess you can just type them into the chat box or the Q&A category, and we'll get to them at the end. So feel free. Let's talk. Actually, the IRS just added new maximum IRA and Roth IRA contributions for 24 just last night. So it's a great opportunity for me to touch on those as well. So what's a Roth IRA? A Roth IRA was created in 1997 by Senator Roth of Delaware. It's really just an after-tax IRA. So you don't get a tax deduction like you would if you made IRA pre-tax contributions. But the beauty is once you're 59 and a half and the Roth's been open at least 5 years, all your Roth IRA distributions are tax-free, right? That is the magic of the Roth IRA. I wrote a book about the Roth IRA called In God We Trust and Roth We Prosper. And I totally believe that. All my retirement funds are in Roth. I believe it's the secret magic of the U.S. retirement system. It's other than life insurance, probably the best legal tax shelter out there. Okay, so in 2023, the most you can put in a Roth IRA is $6,500 or $7,500 if you're over 50, and you can do that until April 15th. Who can make Roth IRA contributions? Well, if you're married, filed jointly in 2023, and you make more than $229,000, you technically cannot make a Roth IRA contribution. And it's $153 if you're single. However, there's a workaround called a backdoor Roth IRA. And the way a backdoor Roth IRA works is irrespective of income limitation. So if you're Jeff Bezos or Warren Buffett, if you make $1 gazillion a year, how you can still do a Roth IRA is you make an after-tax IRA contribution. So you open a traditional IRA, do not take a tax deduction. You make an after-tax IRA contribution, and you literally just move the money to Roth. And why this works is since 2010, the IRS removed any restrictions or income limitations on Roth IRA conversions. So anyone can technically do a backdoor Roth IRA and convert to Roth. Now, the one wrinkle to consider is that if you have other pre-tax IRAs out there, only a certain percentage pro rata of the after-tax contribution can actually be converted to Roth. So for example, if you have $5,000 in a pre-tax IRA from 5 years ago, and you want to do a $5,000 after-tax backdoor Roth IRA because you make more than $229,000, what you would do is you'd open up an after-tax IRA and then convert it to Roth. However, because you have a separate pre-tax IRA out there, there's a formula for how much of the backdoor, that $5,000 contribution you want to backdoor to Roth, can actually go Roth and what must stay or be taxable. And it's a simple formula. You take the value of your pre-tax IRA, you add the after-tax amount. So that's 5 plus 5 in this example is 10. You divide 5, 10, that's 50%. So on the $5,000 of backdoor Roth IRA you want to do in 23, half of it's taxable, half of it goes to the Roth IRA. If you have no other pre-tax IRAs out there, either because they're Roth or you just don't have any other IRAs out there, then you can do a backdoor of up to $6,500 or $7,500 if you're over 50 years old. How does the tax work on conversions? Well, you pay ordinary income tax on conversion, not capital gains, ordinary income. What's your tax rate? Well, whatever you convert, and that's based off the cash converted or the fair market value of the asset converted, because you can also do an in-kind conversion of real estate, of gold, of cryptos, private company stock, hedge funds, interest, whatever you want. It's added to whatever other your income you have for that year. So for example, if I made $100,000 a year W-2 salary, and I want to convert $100,000 in cash to my Roth IRA, I'm going to take the 100 plus the 100, and now I'm going to pay tax on the 200. And whatever my tax bracket is for $200,000 of income, that will determine how much tax I have to pay. So you have some wiggle room because the income tax brackets are quite wide. When you look at the 20% or 24% bracket and how that goes all the way up to 30 or 34%, you have wiggle room, meaning there's hundreds of thousands of dollars in each compartment that will allow you to take additional income in without increasing your tax bracket. So that's where interesting tax planning opportunities present itself. So there's no income restrictions on conversion. It's ordinary income. But remember, you have to pay the tax on April 15th of the following year. So if you convert $100,000 in 23, you're going to add that to your tax return and pay the tax in 24. How can you reduce some of the tax? Well, Steve will get into his strategy in a minute. But other ways is you have net operating losses from your business. Maybe you have high deductions, charitable deductions, or other oil and gas deductions, depreciation, things like that, that could reduce your taxable income. And that's what Steve will really focus on, which is super, super exciting. 2024, I mentioned the IRS just came out with new contribution limits for IRAs and Roths. The numbers have now increased to $7,000 if you're under 50, $8,000 if you're over 50. This is breaking news, just got released last night. The income limitations moved from 229 to 241 and from 153 to 161. So you have a little bit higher income limitations, but again, it doesn't matter because you can always do a backdoor Roth IRA. What are some of the advantages, right? Why would you want to go Roth? As I mentioned, it's the magic secret sauce, right? It's the Super Bowl of all tax-free tax planning opportunities. Once you're over 59 and a half, and the Roth's been open over 5 years, all the money you pull out of the Roth IRA is tax-free, everything. And when you pass, you can leave the Roth IRA to a spouse, and then he or she can pull those funds out tax-free, penalty-free. And if you leave it to a non-spouse, like a child, they'll have 10 years to pull those funds out tax-free, right? So you're leaving a really nice tax-free legacy to your family. So a lot of folks, and that's one of the advantages of life insurance, is when you pass away, your family receives life insurance, it's tax-free. Here, you also can leave a Roth IRA which is tax-free. The nice thing of the Roth IRA versus life insurance is you can actually use it during your life, right? As long as you're 59 and a half, the Roth's been open at least 5 years, it's all tax-free. So remember, you pay tax on the fair market value of the converted asset. So cash is easy to value, right? Cash is cash. But assets, hey, especially liquid assets like private company stock, there are some opportunities to get a discounted valuation. And we work with a lot of very reputable and savvy discounted valuation firms that, based off the fact that the assets are liquid, like an interest in a limited liability, interest in land, real estate in an LLC, things that aren't marketable, you can get anywhere from a 20 to 40, 50% discounted valuation. Obviously, it's based off the appraiser and your asset and the conversations you have based off the facts and circumstances of your asset. But there's material significant tax planning opportunities where you can do a converted discounted valuation of a hedge fund interest, private equity interest, private stock interest, real estate interest, and get anywhere from 20 to 40% discount, pay the tax at a discounted valuation, right? Let's say maybe you bought the investment for 100K and maybe it's only worth 60 or 70 now, right? Or maybe it's worth less with a discount because the fact it's liquid, it's a marketable. Who's going to buy a minority interest in a private equity fund? They may not pay what you paid for. Or who's going to buy a 5% interest in a private company? May not pay what you pay for. Therefore, they may be entitled to a discounted valuation, which will reduce the amount of tax you pay on the conversion. Right? That's the name of the game, right? How do you do a Roth conversion and pay no tax? That obviously is your ultimate tax strategy. Some people can do it through tax planning, like NOLs, oil and gas, which Steve will get into. Some will add a component of discounted valuation to it. And others will just say, hey, I have a lower tax bracket this year. I'm able to take into account a ability to do a conversion and pay less tax. I mentioned Roth IRA. It's really the holy grail of IRA investing. 59 and a half in 5 years, all tax-free, no requirement of distributions. You can leave the Roth IRA to a spouse. He or she can take the money out tax-free. You can leave it to a non-spouse and they'll have 10 years to pull that money out tax-free. You can keep it in the Roth IRA and just live off the money tax-free. If you have real estate, I have lots and lots of clients that have numerous properties in a Roth IRA. They'll get the rental income flowing back to the Roth IRA tax-free. They have the asset that's hopefully appreciating, that home that they can ultimately sell tax-free, or maybe they're flipping a home. Maybe they're buying Bitcoin or gold or private equity or hedge funds. There's so much incredible tax planning opportunities in a Roth IRA. It's, as I mentioned, it's really the holy grail of Roth IRA investing. This is an interesting curve chart that will show IRA to Roth IRA conversions by taking a discounted valuation on the amount of the value and then paying tax on that discounted valuation. Once you take into account getting the discount, time value of money, and hopefully future growth, it generally is a very, very successful strategy. But obviously with Roth IRA conversion, there is no guarantee, right? So what are some of the advantages and disadvantages of conversion? Let's start with the disadvantages. Disadvantages is, I always use the Enron example. Since you're in Texas, we'll talk the Enron world. People can use Silicon Valley Bank. You do a Roth conversion of Silicon Valley Bank or Enron stock or Lehman stock, and it goes bankrupt a year later. So what you've done is you paid Uncle Sam tax on an asset that's now worthless or worth a lot less. That's obviously the worst case scenario. What are other items to consider? Well, your age. Right? Roth conversions probably make more sense when you're in your 20s, 30s, or 40s than when you're in your 90s. Why? You have more time value of money to accelerate your growth tax-free. Your tax rate. What's your tax rate now? Are you at 37% or maybe you're at 20%? That is also a factor to consider whether to do a Roth conversion. What do you think your tax rate will be when you retire? Is it going to be relatively low because you're just going to play golf all day and just live off investments? Or do you think you're going to work till you die and have relatively high income? There's no right or wrong, right? People, I get this question 10 times a day. Should I do a Roth IRA conversion? It's probably the most popular question I get. And the answer is generally, I don't know. I mean, like, honestly, I don't know. Why? Because it's based off facts and circumstances. What may work for person A may not work for person B. It's all the factors I just mentioned. But again, the upside is huge, right? And you don't have to do the Roth IRA conversions all at once. You can do it over multiple years. Let's say you have 200K in your Roth IRA, you're in your 40s, you're in the 24% tax bracket, and maybe you have some wiggle room, right? Maybe there's another 100 grand before you go to the next tax bracket that's higher. Maybe you say, you know what, I'm going to take that 200K and I'm going to convert it. I expect to have relatively the same amount of income over the next 3 to 5 years. I'm going to take 3 to 5 years and convert to 200K. So maybe I'll do 50 or 60K a year and I'll stay in the same tax bracket. And then over 3 to 5 years, bang, it's all going to be Roth. Or maybe on the flip side, you got a lot of losses this year, or you talked to Steve and you looked into an oil and gas deal and you have a huge amount of deductions in the first couple of years that could eat up all the tax on the Roth conversion. You may say, hey, I'm willing to do more. And that's the exciting part. And that's why I'm really excited about today's webinar, because it's very rare that you can find a strategy where you can accelerate deductions and use those deductions to offset the Roth IRA conversion. I did a lot of this back, maybe 12 or 13 years ago, when there was, during the end of the financial crisis, there was a lot of real estate opportunities that states that were federally offering huge deductions for investment in certain areas, especially after Katrina in New Orleans. I remember back in 2009 or 2010, there were unbelievable credits available if you did investments in certain zones in Louisiana, that they were giving you really, really strong credits, which the whole same strategy that Steve will talk about is do Roth conversions and then use the credits to eat up the taxable gain. Unfortunately, those opportunities are no longer available, but the oil and gas opportunities are, and they're super exciting. I've done oil and gas investments, I haven't done them with Steve, just as full disclosure, but I've done oil and gas investments. And I've actually used some of them indirectly to use them to offset other income, including conversions. So when I had the chance to meet Steve and kind of focus on this, I was like, we got to do a webinar on this. It's super exciting, and more people can take advantage of it. So let me jump into you, Steve, and we can talk about how to open accounts at the end, but I think let's focus on the exciting parts of oil and gas investments.
Yeah, thanks, Adam. A lot of great information there. And for the slower people in the room like me, I'll kind of give an example for my own personal, what I personally plan on doing in this strategy. And then again, I will talk about how oil and gas plays into that. But so after my personal strategy is to take my IRA, open up a self-directed IRA, fund that. I have an investment that I want to make. It's actually into a hotel conversion. And I'm going to take my self-directed IRA, invest into that hotel conversion, which is a limited partnership. So essentially the J curve that you saw is when they start construction on that conversion, I'll get a valuation and I'll take advantage of the discount because of where it's in terms of development phase. And then there are two other discounts that Adam alluded to, which is essentially the lack of marketability, it's a non-tradable asset, and the lack of control because you have a minority ownership. So those discounts in and of themselves will add up really conservatively probably 30 to 40%, but sometimes that could be as high as 50-60%. So if I'm able to take advantage of or anyone on here, same strategy, you take advantage of the valuation discounts, right? that in and of itself is a good strategy to reduce your tax bill upon conversion. And again, I want to reiterate what Adam said. You don't have to convert all of your IRA to a Roth in 1 year. You can do a little bit each year, which is part of what I'll be doing personally. And I actually work with an advisor who does nothing but Roth strategy conversions. He just does, all he does is analyze for clients what's the best amount to convert, how much they should convert, and when they should convert. So happy to share that with anybody that wants to reach out to me. So here's where oil and gas comes into play. So you've made the conversion. You've opened up a self-directed IRA with IRA Financial. You've made your investment into, in my case, into this hotel conversion. I'm going to get a valuation done, which is going to give me anywhere from my 40 to 60% discount in my valuation. And then I'm going to hand that to, that's going to be part of my returns when I make my conversion. So I've already eliminated half the tax. So where you can then combine it with oil and gas, if you have liquidity in unqualified accounts, is you can make an investment into an oil and gas partnership, because there are significant tax benefits to oil and gas. Now, I could take an entire hour webinar on my own to explain how oil and gas works, not only the tax benefits, but what are the pros and cons? How do you manage risk? What you should expect, and how do you underwrite oil and gas deals? And happy to do that for anybody on a separate call. But for this purposes, I'm going to focus on the high level of how the tax benefits work. So the IRS basically says through IRS Section 263C, it allows you to take 100%. So in oil and gas, it's called the IDC deduction. You are allowed to write off 100% of the intangible drilling costs of a well. So when you drill a well, roughly 75 to 80%, 85% of the cost of that well, so 75 to 85% of the cost of the well is an intangible drilling cost. An intangible drilling cost is defined by the IRS as anything we use to put into the ground to drill a well that has no salvage value. So 263C says you can take 100% of those costs and take them as a loss in the year of investment. So right there is, you're going to write, if someone puts in $100,000, they're going to get an $80,000 to $85,000 loss on their K1. So typically, because this is a passive investment, you would be limited to only offsetting passive income, which, if that was the case here, would not really work in this strategy here, because the conversion is ordinary income taxed. But IRS 469C3 allows you, so this is why so many people look at oil and gas, direct oil and gas investing as a tax strategy, because 469.3C says that you can offset ordinary income. So that is the home run when it comes to direct oil and gas investments. As Adam said, he's used it personally himself. And in this case, the strategy we're talking about here is maybe you've wiped out half of the tax bill, and I'll give a short illustration in just a minute, and you want to eliminate the rest, and you have the liquidity, you can make an investment into oil and gas. So obviously this can be used beyond just a conversion. You can use just to offset, if you just have a lot of taxable income in a year, whether it's your job or your business, you can use oil and gas as a tax strategy as well. But in this case, you get the big IDC deduction that allows you to offset ordinary income. In this case, it would allow you to reduce that tax bill from the conversion. So the other part of the tangible, the cost of drilling wells, or what's called tangible drilling costs, and that's really anything we put into the ground that has a tangible salvage value when we're done with the well, pipe, casing, production equipment. And that's typically 15 to 25% of the cost of a well. And those are amortized over 5 years, or you can take bonus depreciation, although that's sunsetting down to 80% this year, 60% next year. In this particular case, the big deduction on this conversion would be the IDC deduction. But the last tax benefit, just as a side note, for oil and gas investing, oil and gas investment is not just a tax strategy, it's also an investment. You will start to receive income off of the fund you've invested into when the wells start producing. And the other one's called the small producers tax exemption, which is section 613, which basically says you only pay tax on 85% of the income you receive. So the first 15% is tax-free. So a lot of tax incentives in the code that have been there for decades to incentivize investment into the development of hydrocarbons in the United States. They've been around since the 70s. It's not a gray area, a lot of case law. You're not playing in the gray areas here. So you can combine that. So just as a reminder, You're taking advantage of the discounts, and then you're combining it with oil and gas, and you could potentially reduce all or eliminate the tax. So, Adam, if you could go to the next slide. So here's a very quick illustration. Let's say that somebody is it's the same person on the left and right side. They're converting a Roth. They go through the process. They open up a self-directed IRA with IRA Financial. They put that into some sort of non-tradable asset. They go get a valuation firm, and the valuation firm comes up with 50% discount. So now that $200,000 you've converted, you're only being taxed at $100,000. My example is just easy for the purposes of illustration. Just assume a flat tax rate of 35%. You owe $35,000. So on the left side, that's what the person that, open up the self-directed IRA, put it into a non-tradable investment that you like, take advantage of the discounts, and you've just moved over $200,000 to a Roth, and you only pay tax on half, and that's still a great strategy by itself. So if you have liquidity on the right side, that same client could do the same thing, convert 200, take advantage of the fair market value discounts. They have $35,000 in tax rate conversions. They can make an investment into an oil and gas investment of $125,000, which has 80. For this illustration, I'm assuming 80% of intangible drilling costs. That's going to create a loss of $100,000. So that loss is going to wipe out the $100,000 tax bill from the conversion. So the person on the right now pays zero in tax. So that is a very simple illustration that effectively illustrates how the strategy we're talking about. Now, not everybody has the liquidity to make that investment, and it needs to be suitable for you and for your portfolio. But if you can, on top of the discounts from valuation, you can combine it with an oil and gas evaluation and investment and wipe out that tax bill. So personally, that's what I'm going to do myself. I learned this actually through my relationship with Adam and also some advisors. It's something I'm absolutely going to do for my own conversion as well. So Adam, that's the end of that. We can go into the next. So for Invito, by the way, if you have, like, oil and gas is a totally separate asset, right? So I think you should always have a good CPA, good advisor talking about this conversion strategy, the tax benefits or the tax ramifications. If you want to look into oil and gas investing, it's invitoep.com. Just click on our current opportunities. You can get into our data room, or really I would click the schedule call down below, and we'll get on a call with you and explain, take some time to walk through all of the details of how oil and gas investments work. But when you click on that current opportunities, it'll take you to the next slide. Adam, if you go down one, fill that out, and you'll get an email. And all of our fund information is held on a fintech platform called Tribexa. All the due diligence documents, investment docs are in there. Everything you would need to evaluate the investment. So would love to take time to explain to you how oil and gas, educate you. It's not for everybody, but it's suitable for certain people if you have the liquidity, and would love to share with you how that works.
So, right, one thing, Steve, amazing information. One thing I just want to add is I actually believe, and I think what you said is 100% true, that oil and gas is actually a better investment to do with non-qualified, non-retirement funds.
Absolutely.
Retirement funds, right? Because of the tax benefits.
So, all right, Ed, we've got, well, you can go back to your slides so they can see how they go into IRA Financial if you want to show them that real quick. And then I'll jump into, we got a lot of questions.
Okay, go for it.
Yeah, so let's see. I don't think that we're going to get to all 20 of these.
I'll handle the IRA ones. You take care of the oil and gas ones.
Yeah. All right, so let's look at this first question. I discussed this strategy with my accountant a couple of years ago. The Roth conversion amount is taxed as ordinary income, correct? My accountant said a limited partner investment and a limited partnership is always passive. That means an LP loss is not deductible against other income. So there would be no deduction for the LP loss. What is the difference here? So that was what I talked about. If you're referring to using an oil and gas investment, that's what the IRS Section 463C, that's the uniqueness of oil and gas investments. So it is the only investment out there that is a passive investment by definition. but allows you to offset ordinary income. And the way that works, and I don't have time to go into it, but whoever this is, if you want to, get on a call, we'd be love to do this. But you come into the limited partnership as a GP when the wells are brought online. It's an automatic conversion to an LP, and that is how you qualify to offset ordinary income. So that's the answer to that question, if I answered that correctly.
And this has been long proven law for many years. Like I did an MLP, oil and gas, I think it was like 8 or 10 years ago, and that's why I didn't do it in a retirement account. I did it with personal funds.
Yeah. All right, so same persons, let's say that I get the LP loss to offset the taxes on the Roth conversion this year, but in future years, as the value of the LP interest returns, hopefully to the original investment amount, wouldn't have EV taxes on those gains. Are those gains like real estate depreciation that the gain recouped each year of a time of sale asset would be taxable as ordinary income? Okay, 2 answers to that. And Adam, if I mess it up, feel free to jump in. First off, the income that's being returned on the value of the investment that you made inside the Roth or inside the self-directed IRA, in my case, the hotel conversion, that goes right into the Roth, so it's not taxable, right? In terms of the investment with the oil and gas, yes. As you start to receive distributions, because you took the offset against ordinary income, the IRS is going to make you pay tax. So as you receive revenue from the fund and the distributions from the wells, you will pay ordinary income tax rates on that income that comes back. So the IRS isn't going to allow you to offset ordinary income and then not pay ordinary income as it comes back. Let's see here. I think whoever anonymous attendee is, you got a lot of good questions. I would say that you give me a call. So I don't want to take up, but there's a lot of great questions specific to oil and gas, and I don't want to take up the whole webinar on oil and gas, but I would love to answer your questions. All right, here's one for you, Adam. Is this info applicable to a solo 401k conversion to a Roth?
Yeah, same thing. Exactly. So it's a great question. If you have a solo 401k, you're self-employed, have a business with no full-time employees, and you want to go pre-tax to Roth, same rules, conversion, ordinary income, no income limitations. It's on your 1040 as ordinary income, and then the oil and gas, if you do the investment with personal funds, right? It's just to be super clear, the oil and gas investment is not made with retirement account funds, because if you did an oil and gas investment with an IRA or 401k, you're going to not get the tax flow and the depreciation deductions because it's a tax exempt, and the ordinary income down the road, as the individual correctly stated, would actually be subject to UBIT, unrelated business income tax, if it was done in a retirement account. So oil and gas investment, again, is a great investment to be done with non-retirement funds, but when you combine it with a Roth IRA or Roth 401k conversion, you can almost zero out in some cases, or get close to it, the tax on the conversion.
All right, let's go on here. All right, beside the higher contribution amount, how is a Roth solo 401k different from a Roth IRA when it comes to a tax-free conversion from a non-Roth solo 401k?
Same rules. Roth IRA, Roth 401k. If you convert pre-tax IRA to Roth IRA, pre-tax 401k to Roth 401k, ordinary income tax, same rules apply.
Where can I get my assets valued so that I can convert at the lower value? I know that, Adam, you got a lot of good relationships. I have relationships with accounting firms that do this. I think either one of us could give you a reference to firms that do that.
Agreed.
All right, so let's see here. And if allowed to convert solo 401k to Roth, is it still possible to self-direct invest those now Roth solo 401k funds?
Absolutely. Yeah, if you have, let's say, you have 100k pre-tax IRA or 401k, you convert it to Roth. The money's in your Roth now, not your IRA, but it's still in a qualified retirement account. And the whole strategy is offsetting the tax on the conversion. But you now have a Roth that you could, keep buying real estate, investment funds. Just don't do oil and gas. It doesn't make sense. Do that with personal funds. Use the deductions generated by the oil and gas investments to offset any tax owed on the conversion. But yeah, you have a Roth So you can do stocks, or you can do alternative assets like real estate.
And of course, that's the key is there that you're in a self-directed Roth or a self-directed
Yeah.
IRA.
Right.
Well, as long as you're in a self-directed account, you can make the decisions where the money goes.
Yes.
Will we get a recording of this? The answer is yes. Steve, can you share the name of the consultant that does the Roth conversions? Is it Craig Ware? I don't know Craig, Tom, but the guy's name is Jim Ammerman, and he's actually on this webinar. So Jim is a guy that specializes 100% in doing analysis of Roth conversions for folks. Shoot me an email. I'll be happy to get his contact information for you.
Yeah, and that's super important because it's very fact and circumstances. You can't just say, well, it was good for my neighbor, so it's good for me. That's not true.
Yeah. Let's see, how long before I receive income from an oil investment and at what percent? How long before you receive an income, it just depends on what you invest in, but typically, the fund usually closes at the end of the year and you'll start receiving your distributions the second or third quarter of the first year. So you'll get your K1 in March. The assets will be being put to work in the first year and you'll start to receive distributions by Q2, Q3. In the context of IRA to Roth conversions, can we consider an I-401k is equivalent to an IRA?
Yes, yeah, an I-401k is a solo 401k. You pay ordinary income tax if you convert an IRA to Roth, or a solo K pre-tax to Roth. Ordinary income, no income limitations, same rules. But just make sure your 401k allows for Roth conversions. Most do, ours does obviously, but if you are doing it with an employer, just double check.
Where does the 50% valuation discount come from? Can you explain in both cases here? The 50% valuation discount comes in terms of the asset that you put into your self-directed IRA. And so if you're investing into a non-tradable asset, like for example, my example was this hotel conversion investment here in Texas, down in Houston, that I want to participate in. So you're going to go to a firm that does these valuations, and there's three different types of discounts that you can get. There's one, the development of the asset. So for example, this hotel conversion, if you do the valuation at the beginning where construction's just beginning, before it's fully leased up, the value of that investment it's much lower than it will be when it's fully leased up and rent's coming in the door. That's one. The other one is there's what's called the lack of marketability, because it's a non-tradable asset, and because it's lack of control because you have a minority interest. So all the three of those, correct me if I'm wrong, Adam, but all three of those can add up to anywhere from low side, really low side, 30%, 50, 60% discount. Is there any something else I should add to that, Adam?
No, it's 100% accurate. And all this is based off very, very long-standing case law involving family limited partnerships all the way back in the 60s and 70s and 80s. So this is very standard. Yeah, the IRS could contest the valuation. There's no penalty. They would just ask for another valuation. But generally, what I've found is when you convert money, the IRS is super happy. Why? They're getting tax revenue earlier rather than later. So it's very, very rare they're going to question a conversion, even if there's a discount. They, first of all, don't know it's a discount, but they rarely question valuations of conversion, of in-kind assets, because the IRS wants the money. They don't want to wait 20, 30, 40 years. They want the money now. Governments think 4 years, 8 years down the road for budgets. So if you're giving them free money now in a conversion, they're going to grab it.
Okay. Let's see. If you convert a house housed within self-directed IRA to a Roth self-directed IRA, is an oil and gas investment outside the IRA a suitable offset?
Yeah.
Yeah. So
whether you convert cash or a house or cryptos or private stock, yeah, it's just you're paying tax on the value. So sure, doesn't matter.
Then another one. So after year 1 or 2 of oil and gas, can oil and gas be put into a Roth before ordinary income comes in?
No, once you own it personally, the asset's tainted. You can't just transfer it to a Roth. I wish if I ran for president, I'll make sure that rule becomes law. But the IRS wouldn't be very happy because
Yeah.
everyone would do that and shelter all their income.
Can I convert into a Roth from a self-directed defined benefit plan?
From a self-directed, from a DB plan, you're not going to be able to because it's a pre-tax plan. There may be a Roth component in the 401k, but you should ask your third-party administrator, your DB administrator. If you have questions on that, I actually own 2 pension companies that specialize in defined benefit plans. So most of the conversions are done outside the plan, like in the 401k or when it's rolled into an IRA down the road.
Okay, great question. All right. I don't understand the distinction between keeping the oil and gas investment in a taxable account but getting the Roth tax savings.
Okay, let me. It's a good question. I should have been more clear. That's my fault. So let's say, for example, I have $100,000 in a Roth IRA. Okay, and let's just say it owns stock in my friend's business. Okay, and I want to convert all of it, and I in the 30% tax bracket. Okay, so I'm going to go get a discounted valuation of the 100,000, and maybe someone says it's worth 70. And I'm going to pay 30% tax on the 70, which is 21K. Okay. Then I'm going to take another, let's say another 100 grand of personal non-retirement money. Okay. Not my IRA. I have another 100,000 bucks of non-retirement money sitting around and doing something else. And I'm going to do an oil and gas deal with Steve, let's say, and he's going to generate $20,000 of deductions for me in the first year, maybe more, but let's say 20. And that 20 is going to offset the 21,000 of tax I just paid on the discounted conversion to a Roth IRA. That's kind of how it works. You have to take a Roth. You need a Roth. You need a pre-tax IRA or 401k, and you also need other money, non-retirement money, to do the oil and gas deal to generate the deduction to offset any tax on the conversion.
Great explanation. Let's see. Let's see. I am 60 years old and have a large IRA self-direct account. If you don't have it with IRA Financial, I suggest you switch over. Just kidding.
Smart man. He probably does. Yeah, or she does.
I am interested to convert 30% to a Roth IRA. I plan to convert in 3 separate years. When can I start to withdraw? Year 6, 7, or 8?
Okay, so each conversion is a great question. Great question. Each conversion has a new 5-year window. So if you convert over a 3-year period, the first conversion you did, let's say in 23, you got to wait 5 years from that, 20 to 28, plus you have to be over 59 and a half to get everything out tax-free. If you're over 59 and a half, you could pull out whatever you convert tax-free right away. The earnings on the conversion, you got to wait 5 years and 59 and a half. If you're under 59 and a half, you got to do the 59 and a half and the 5 years. But each time you do a conversion, there's a new 5-year window. So let's say in 23, I convert 30K, and I'm under 59 and a half, 5-year window, okay, and 59 and a half. Next year, I convert another 30. 5 years from year 2, I got to be over 59 and a half. If I convert and I'm over 59 and a half, if I convert 50K, I can pull the 50K out the next day. If I want to convert and the earnings, so let's say I convert 50K and that 50K is now worth 70K 5 years later, I got to wait 5 years and 59 and a half to pull all 70 out. Okay, so it's a little bit confusing. A lot of people don't know these rules, which is another reason you want to work with IRA experts. I would say IRA, it's in our name, like that's what we do. We don't sell products, we sell and IRAs and 401k. So just remember, it's a great question. If you're over 59 and a half, you can do a conversion and pull whatever you owe. You convert it out tax-free the next day, but the earnings on what you convert, which is the juice, you got to wait 5 years. And then there's a new 5-year window for every year you do a conversion. So for me, I actually converted all my money over like a 5-year period. Like from 2010 to 15, I think I did it. I'm under 59 and a half, so I didn't care. I had to wait the 5 years anyways. I'm at that point, I was in my 40s, early 40s. So I was like, who cares? I'm going to wait 5 years anyway, so it doesn't matter. But if you're 57, 58, yeah, you got to take into account, you're going to have to wait the 5 years and be over 59 and a half. If you're over 59 and a half already, whatever you can convert, you can pull out the next day. But the juice, the earnings on that conversion, you're going to have to also wait 5 years.
Let's take a few more. What if we already own a real estate portfolio and want to get a valuation to convert to a Roth solo 401k? Can your contact help private real estate investors like me?
Sure. If it's in a if you already own the real estate in a retirement account, sure. The
Yes.
appraiser can discount the real estate in an IRA or personal. But if you own the real estate personal, obviously you can't get it into an IRA, right? Because it's tainted. Then we all would do that. Again, we would all just put all our assets we own personally into a Roth and never pay tax. And the government probably wouldn't be very happy about that.
Do you need the valuation discount to offset the conversion tax? You don't need it, but if you want to reduce the tax bill, that's a strategy you can employ.
You don't have to, right? I have some clients who are like, you know what? I don't want to do a discount. I don't need it. I have losses that more than cover the tax. Or maybe if you talk to Steve and his team and you see the oil and gas kind of eats up most of it anyways, and you say, you know what? I don't want to be aggressive. I just want to kind of just pay the tax on the conversion. That's perfectly fine.
Yeah. For the value part, if the GP partnership is providing the value letter, how does that work with third-party firms mentioned, which is taken or valid? For the value part, if the GP partnership is providing the value letter, so the GP partnership is not providing the value letter. So you're going to go to an evaluation firm that's going to do that, an independent third-party valuation firm. Correct, Adam?
Yeah, but let's be clear. The discounted value is not on the oil and gas investment. The discounted value is on the Roth. So it has nothing to do with the GP oil and gas investment. That's with personal funds. The conversion, which is an IRA converting to a Roth, that is up to you to provide the value. Now, if you want to do a discounted valuation on cash or Tesla stock, that's going to be more difficult because there is a readily ascertainable value to that, just like Bitcoin or anything you can just get in value that has a tradable market.
Yep. Great question.
Yeah, some really good. You guys are awesome. Really great questions. Smart group of people here.
Is there a 5-year wait on 401 pre-tax to Roth conversions? Is there a five-year wait on 401k pre-tax to Roth conversions?
Right, but just remember with a 401k, it's kind of a moot point. Why? Because if you're under 59 and a half and you're still in the 401k, you can't take the money out of the 401k anyways. So the 5-year window really doesn't matter. But if you're, let's say, 57 or 58, yeah, technically you still got to wait the 5 years and the 59 and a half.
Says Adam, in your $30,000 example on the 5-year rule, are these needing a separate Roth, separate IRA accounts for each bucket converted annually?
No, you can use the same IRA account. You got to keep track of it, which will help you do. You just got to keep track of the separate 5-year windows for each conversion. And how will the IRS know that? Well, when you do a Roth conversion, we file a 1099-R. So that puts the IRS on notice of who you are, your age, and that's how they can kind of keep track if they ever wanted to audit you.
What happens to the Roth IRA if I die before the 5-year requirement to start withdrawing?
Yeah, your heir would have to take that into account. So God forbid you pass away, let's say you're 3. Yeah, your spouse is also under 59 and a half. The IRA, the Roth would go into your spouse's name. So then it would based off his or her age, but he or she would also have to take into account the 5-year. So that's something that does pop up. Thankfully, less so because thank God most people that do pass are over 59 and a half. But yeah, that's something you have to take into account.
There's a lot of questions in here about specific to oil and gas returns. Yeah, look, the oil and gas investment has the upfront tax benefits, but it's also an investment. So yes, there are risks to that. It needs to perform. There are expected return profiles, all of which is in our data room. All I'm very happy to do on a separate call one-on-one, or get into the data room and you can see our financial projections. But yes, if the asset, it's just the same example Adam gave, right? If you make an investment, I think you gave Silicon Valley Bank and Enron, right? If you use let's say if you make an investment into oil and gas to offset the Roth, and the oil and gas investment doesn't return any money, then you didn't come out ahead. There's no doubt about that. So that's why if you're going to look at an oil and gas investment, you need to understand the tax benefits, but you need to understand much more beyond that. And that's what we'd love to do on a one-on-one call, and walk you through how that works, what your expectations should be, what are the risks, and how do we manage those risks.
Right. We should have said this up front. We're not promoting any investment. We're not giving investment advice. This is just purely educational. But yeah, I mean, like I've done oil and gas deals. Some years they're good when oil is high, and then there's investments that don't work out when the oil market tanks. That obviously impacts the value of oil and impacts the value of the investment. So there's nothing guaranteed in life. Anyone who tells you that it's guaranteed returns, like obviously you got to question that. But the nice thing this strategy does is it also gives you tax benefits. So hopefully you have a really good, successful investment in the oil and gas investment, but you also get a tax benefit to go along with it.
Yeah. And again, I'm not trying not to answer the questions. When we talked about doing this webinar, this wasn't meant to be a pitch for the Invito Fund. It's what we do. Happy to talk to people about it and answer all those questions in detail on a separate forum. Last question. It says, Adam, I thought I heard you say that rental income from a rental property inside of a Roth converted IRA could be distributed tax-free later, so long as you satisfied the 59.5 and 5-year requirements. Is that accurate? Your rental income would be tax-free forever thereafter?
Yeah, you got it. That's the play, right? You buy a house. Let's say you buy the house for 100K. Maybe it's worth 80 or 90 now. The real estate market's not great. You convert it and you get $1,000 a month rent. That goes back into the Roth IRA tax-free. So once you're over 59 and a half, Roth's been open 5 years, literally pull it out if you want or not, live off it. And then let's say you sell the house in 20 years for 500K, it's all tax-free. So you get 2 streams of income that are potentially tax-free, which is what a lot of my clients do as they get older. They're like, listen, I love the cash flow. I'm going to have it Roth IRA. I don't have to worry about tax rates. I don't care who's in DC. I'm pulling the money out tax-free. And that's what they do.
Okay, one last question, because it's a good one for you, Adam.
Oh, no.
It says, does IRA Financial offer one-on-one consultations? I do have an IRA Financial account. Well, it's one of your clients, buddy.
Call us. We'd love to. We have our phone number right here on the screen. You can chat us, email us, call us. I have an amazing team of, I don't know, 80 people plus that we spend a lot of time every week training and becoming smarter at what we do. So we're here to help. Even if you're not a client and you're watching this, like you have an IRA question, we'll answer it. We don't care. We want to educate people, and that's the name of the game. So absolutely contact us, and you will get, whether it's me or someone on my team, we will get you the answer you need.
Fantastic. Same for us. If you have any questions if you want to look into oil and gas, invitoep.com. My number's right on here. Here's my email. Feel free to reach out to us. And of course, Adam's a great place to go for way more than the oil and gas side. So
IRA, not oil and gas.
Well, great, good job, Adam.
Thank you, Steve. Awesome job. Thank you, everyone, for attending. Really appreciate it. You guys are unbelievable, smart, and just great questions. So we're here to help, and hopefully you guys found this interesting, and we'll keep doing them. So thanks again for hanging out with us. Appreciate it.
Thank you. Everybody have a fantastic day.